I'd like to introduce our moderator, Brendan Walsh. Brendan is the CSH tax leader and a shareholder who specializes in tax consulting for businesses and their owners. His work focuses on strategic tax planning to minimize tax exposure, specializing in fixed asset strategies, depreciation, cost segregation, and tangible property regulations in the construction and real estate industries. Brendan has worked with companies ranging from startups to billion-dollar publicly traded entities. I'll pass it off to Brendan to get things started and introduce our presenters.
Great. Thank you, Allie. And again, welcome everyone and good afternoon. As Allie said, my name is Brendan Walsh, and it's a pleasure to speak with you all today. I want to first thank you all for joining us and welcome you to the second of our 2 year-end tax planning webinars. As Allie mentioned, today's webinar focuses on year-end tax planning for individuals. Now, last week, we hosted our year-end tax planning webinar for businesses. In the event that you missed that presentation, there is a link in the resource list feature of this webinar. That's the gray box that you should see on your screen. You can use that link to watch the business webinar on demand when your schedule allows. With that being said, I will go ahead and introduce our presenters. Mark Gaudette is a shareholder with the firm and serves as an advisor to corporate executives, high net worth families, and closely held businesses and their owners. He assists clients with their income, estate, and gift taxation planning, as well as compliance matters. Mark is a senior member of both the firm's personal wealth planning and executive assignment groups, which specialize in asset planning strategies. Larry Powell is also a shareholder with the firm. He is an estate, gift, and trust tax specialist and is chair of the firm's personal wealth planning services group. Larry's specialties include income tax planning, estate planning, and business succession planning. He is also a member of the firm's tax committee, ensuring the overall quality control of the firm's tax practice. Income tax preparation and planning are critical to preserving wealth, and Larry has over 24 years of experience working with individuals and business owners in this capacity. So before we begin the presentation, we do have our first polling question to jump into. So you can see there, are you confident in how to make the most of your itemized deductions so you aren't wasting them? A, yes, I have it covered. B, I'm somewhat confident. Or C, no, I could use some help. Go ahead and take a minute to answer that first polling question if you could. While you're answering that, just a reminder that if you have any questions during the presentation, go ahead and use that Q&A button on your screen and type your questions in there. We will do our best throughout the presentation to get to those questions. Most likely we won't be answering any questions during the presentation, but at the end, if we do have some time, we will address as many of those as possible. With that being said, I will go ahead and turn it over to Mark and Larry.
Good afternoon, everyone. Thanks for joining us on a fine day here out of Cincinnati. So I'm going to be co-hosting from Cincinnati. My colleague and fellow shareholder Larry Powell will be joining us from another beautiful remote location. But today's agenda, we have a couple of topics that we're going to discuss, and I think we're fortunate that this presentation is after the presidential election that happened in early November. I would like to think we have some level of certainty, but as I think we'll discover that there's still a lot of things to be uncertain about on the tax agendas as we look for President-elect Trump to take office in late January of 2025. So we're just going to go through the items here. We're going to talk a little bit about the impact of the election, what's new for 2024 under the current laws in which we practice under. Talk about filing status, income management strategies, deductions, credits, retirement planning, investment strategy, estate gift, some checklist and key dates as we think about the end of the 2024 tax year, and then we'll wrap up with a few closing remarks. New this year is we added some additional guidance at the end of the PowerPoint presentation that we're not going to cover in detail, but some thought-provoking slides that'll help you when you're talking with your advisory team and allow you to have some more in-depth conversations to, really specifically address your specific issues. So with that, we're going to go into the impact of the presidential election. As most of you know, there was a lot of uncertainty leading into the election and what the makeup of Washington would look like. And so as we've had time to settle and the dust has settled, we know that the Republicans have control of the Congress and control of Senate and the White House, although by super thin margins with the Senate and Congress. It now leads us to a little bit more discussion on what the tax impact could be as we look at the expiring tax cuts from then President Trump's agenda back in 2017 with the Tax Cuts and Jobs Act. And so we know that bill, most of those provisions were set to expire at the end of 2025, and we would revert back to the tax laws as they were written prior to the enactment of the 2017 bill. And 2026 was going to be a landscape of uncertainty on how this would play out in the presidential election. We know that the sunsets are still in place, and when following President-elect Trump on the campaign trail, he made a lot of promises on what his tax policy would look like. And I think probably foremost, the most important one was an extension of, I would argue, the favorable provisions of the 2017 legislation that is set to sunset at the end of 2025. And those would be items such as retaining a favorable top marginal income tax rate for federal tax purposes of 37% as opposed to 39.6%, retaining a strong child tax credit at $2,000 as opposed to $1,000, the increase in the exemption phase out for the alternative minimum tax, which really took a lot of taxpayers out of the alternative minimum tax. The phase out went to married taxpayers with modified AGI over $1 million. Subject to sunset, it would be the phase outs would start to occur at about $170,000 level. So looking at those items, strong standard deduction now in 2024, it's at $29,200. Before TCJA, that was right around $12,700. So some very favorable provisions. The ones that impact those that are business owners that have pass-through entities and that our colleagues talked about last week would be the qualified business income deduction, the 20% deduction for qualified business income, bonus depreciation, strong expensing of bonus depreciation that has been scaled down over the last couple of years and is subject to go to zero after tax year 2026. Those are some of the key items that Trump was talking about in his campaign stumps. But a couple of other things that he added into the agenda was no taxation on Social Security, no taxation on tips, no taxation on overtime, maybe a deduction related to the purchase of interest related to the purchase of an automobile. If you look through his agenda and a lot of the descriptions on those provisions, there wasn't much guidance, if any at all, provided besides just a couple of key remarks in certain speeches. So it's uncertain on what's going to happen. What we do know, and as our colleagues talked last week on the business webinar, Zach Gubser, one of our fellow shareholders, went into great detail on what tax legislation could look like under this regime in 2025. The timing of legislation most likely could be as late as the third quarter of 2025, although Trump has a pretty strong agenda that I think he would like to have it enacted a lot earlier in the year. But typically, a first-term president, their legislation comes out in the third quarter of their first year. So following that timeline, we'd be looking into the fall regime and most likely have provisions that might take effect for the sunset of early January 1 of 2026. Larry, I don't know if you have any comments on this before I progress.
No, I think you covered it really well. I think some of the things that are permanent, like corporate tax rates are not subject to phase out, or those are permanent, and which is already 21%. I think one of his promises was to get that down to 15%. The SALT cap, kind of goes away. So he kind of promised that on the trail, and so there's a lot of moving parts with the TCJA and what provisions they want to extend and what they may have to negotiate out, but be interesting to see.
Yeah, it's interesting. Earlier in the year, the Congressional Budget Office gave their projection on what the extensions of the 2017 tax cuts would look like, and the cost for the 10-year cost to just extend the provisions of TCJA, favorable and unfavorable, was targeted at $4.6 trillion. So when you look at that, the question really becomes, we've heard about where the tax cuts would come and what the new provisions that President-elect Trump would like to enact. The question is, where do the funds come from in order to get to budget reconciliation and the offsets and the revenue raisers? So what we've seen over the years is we've really seen an expansion of the tax base. So the items that are subject to tax in really holding the marginal rates in bay. So when we think about items are taxable or non-taxable, Larry mentioned the SALT cap. So, really expanding the tax base. So we lost some level of deductions above $10,000. And that's what we'll probably see more of in 2025 is the gamemanship of what is taxable and non-taxable and the expansion of the tax base and really trying to control the marginal rates. With that, we have a handful of slides to talk about what's new for 2024. The good thing is for tax year 2024, there was not a lot of meaningful legislation besides, we had Secure a couple of years ago, we had Secure 2.0 that talked really about retirement benefits and other things. So some of these provisions are new, but I think it's just important to keep your eye out. These are not part of TCJA, but Secure 2.0 in particular introduced some new provisions for 2024. The credit for electric vehicles, they added a provision for used vehicles, which was not in there before. So for those that buy an EV, there's a tax credit that's out there that now applies to used purchases. There were some retirement changes. There was a provision for penalty-free withdrawals for $1,000 for emergencies, and then a penalty-free withdrawal for folks that experience domestic abuse and the ability to access some retirement funds for some relief and to cover some expenses. Probably one of the key provisions that was in Secure 2 was the increased limits for workers age 60 to 63 on some catch-up provisions. So really a small window that's out there for workers that are in that 60 to 63 really to boost retirement savings. So more dollars that can be set away for retirement as taxpayers continue and the U.S. population continues to age.
Yeah, Mark, couple quick follow-ups on that. So yeah, the electrical vehicle credit, I mean, that's something you can either take on your return or you can, have the dealer take that credit. It is income limited. So, married joint over 300,000, you get limited. You won't, I've had some clients that they crept up over that and didn't get the credit. So there are some income limitations to that. And the penalty free on some of those withdrawals, they're still income taxable. There's just no penalty for getting to it. So just wanted to touch base on those things.
Perfect. Continue to move forward. Some of the press that was out there on these provisions was some catch-up contributions must be made to Roth accounts. So these were highly folks that were high-income folks that if they were going to do additional set-asides for retirement assets, it was going to have to be into Roth accounts. And we're talking about qualified plans here. That was pushed out to 2026. It was originally going to be a little bit sooner, but they've kicked that down the road a little bit just because of the compliance matters and the complexity of setting up those accounts. There was a provision that talked about the leftover 529 monies could be rolled over tax-free into a Roth IRA. This has a lifetime cap of $35,000, so it has some limited benefit, but for those that have had set up 529 plans, they're mature accounts. They've had to be in place for a number of years. If there's leftover monies, up to $35,000 could be rolled to a Roth IRA. So I would still argue you use the 529s. Remember the provisions that were enacted a handful of years ago that allowed for 529 plans up to $10,000 a year could be used for K through 12 tuition. So that's a nice provision to use some of those $529. And then for those that are, for college and above, but if anything's left over, there's a little bit of ability to put it into a Roth IRA. as the population is aging.
Just remember those. I've had clients that really super stuff those 529 plans, and you run out of grandchildren because you can transfer it, keep transferring it to other grandchildren or children. But at the end of the day, when the wheels stop spinning, those are subject to income tax and penalty if there's money left over after, maybe the 35,000 of the Roth. So I think people need to be a little bit cautious of not overstuffing those things.
I would agree. And as I mentioned earlier, the aging population here in the U.S., they've pushed out the required minimum distributions now starting at age 73. It used to be 70 and a half. It's out to age 73. That's gradually going to increase to age 75 by the year 2033. I'm going to make a statement not to confuse anyone, but we enacted a few years ago was the qualified charitable distribution from an IRA that is applicable for anyone that is age 70 and a half or older is allowed to take up to $100,000 from their IRA directly to charity. That's been indexed for inflation. So now it's $105,000. That is still at age 70 and a half. It did not move as the RMDs moved out to 73. So if you're 70 and a half in a given year, you can take up to $105,000 from your IRA directly to charity. It's not subject to income tax. You don't get a deduction for it on your individual income tax return, but it's a nice way to use your retirement assets to fund charity during your lifetime at 70 and a half or older. The next couple of slides, we're just going to talk about a couple of key things when we think about year end. Your filing status in a given year for each tax year is determined on December 31st of that year. So whether you get married or divorced or widowed in a given year, your filing status is determined as of midnight on December 31st of that given year. So as a single taxpayer, you don't have many options. You file and use the single income tax rates and brackets that are out there. Married taxpayers have the ability to file a joint return, or they may file married filing separately. Head of household, for those individuals that maybe went through a divorce situation and have dependent children, might qualify for head of household status, and those have favorable rates compared to the single tax rates. And then a qualifying widower, if you're in a situation where your spouse died in a given year, you'll still file a joint return in the year of death. But if you have dependent children, you might have qualifying widower status in future years. So your filing status determines income tax rates, deductions, credits, phase outs, and all of those things. But I think the last point is it's determined as of the last day of the year. A couple of items that impact on the filing status is obviously we've heard about the marriage penalty from an income tax standpoint. If you look at the brackets for single taxpayers, and if you were to multiply those by 2, you don't necessarily get to the joint married filing joint. And if you look at married filing separate, it's not necessarily 1/2 of married filing joint rates, and it's not equal to independent single rates. So a lot of times your tax professional will run a calculation to see what's beneficial to file joint or separate. Sometimes there could be benefit on a federal return, but you forego that benefit on a state return or vice versa. So something that your preparer is probably looking at and determining if it's better to file joint or separate in a married context. The timing strategies, obviously, thinking about life events. If you're contemplating a marriage and looking at what the tax rates would look like between December 31st and January 1st. So if it's favorable to be single in a given year, you might defer that wedding until January 1st of the following year. You just need to look at the different tax consequences, and your advisor can do that. The status changes, reviewing implications of a divorce or separation, and what filing status would you be eligible for. Again, if the decree is finalized by the last day of the year, you'll no longer be in a married situation, and you would file as a single taxpayer or maybe head of household. It all depends on the circumstances. And what we remember from a few years ago is that alimony is no longer deductible for divorces that occurred after 2017 or into 2017. So the ability to deduct alimony or the requirement to include alimony for any separation starting in 2017 and forward is no longer deductible or taxable. A couple of quick slides just to talk about dependents and qualifying dependents, what those look like. Really we think about, children under the age of 19, or if they're in college or full-time students, it might go up to the age of 24. We got to watch out for the kiddie tax provisions where we would have shifting assets to our children, and then those children's trying to capture favorable rates at their low income levels, but the kiddie tax provisions will apply for dependent children and for college age children that are still dependents. Talk about relationship trust, residency trust, no significant change in these. And then if you have a dependent that does not meet the qualifying child definition, they might be able to meet the qualifying relative definition, and no significant changes in these provisions, but just a refresher on what's out there.
Yeah, and I think there's no deduction anymore for a dependent. That's been out of here for a few years, but it is a gateway into other deductions and credits when it comes to either education credits, child tax credits, or those things. And Ohio, you get a small deduction, but federal, you don't.
Yeah, so one of the provisions of TCJA that would come back if it were to expire starting January 1 of 2026 is we would have the dependency exemption would be back on the table. We have a handful of slides that talk about income management and strategy. So as we think about year-end planning, we have approximately 21 days left in the year if my calendar is correct. So things that we talk about, and as we think about 2024 and 2025, as Larry and I have done this for a long period of time of planning for our clients, when we look at income tax projections, we always look at the current year and we look at into the future and at least into the next tax year. So when we look at the landscape between 24 and 25, at this point in time, feeling fairly comfortable that we're going to have pretty much the same rate environment. We're not worried about a spike in income tax rates going into 2025. We know in 2026, without any legislation, that we're going to have an increase in rates, and some favorable and non-favorable provisions of TCJA fall off the table. So if we're looking at, income spreading or leveling from either an income or deduction standpoint, I think it's critical that you look at both the current year and the next year on the table to see, does it make sense to accelerate or decelerate income and or expenses? So those provisions would be, if there's a change in marital status, you might think about what's it look like between 24 and 25. If there's a significant increase in income next year, it could be some type of bonus incentive, could be equity compensation, or it could be other windfalls that you receive that would be taxable. Just increase in overall income and portfolio income is moving some people up into higher tax rates. I think with the strong market conditions that we've experienced over the last 2 years and the high yield on income earning accounts, we're seeing a lot more people pay more tax on their interest income that's taxable. And so just taking a look at that and making sure we're thinking about what that looks like, and does it make sense possibly to think about restructuring the portfolio, and where do treasuries come into play? Where do municipal bonds come into play? As some people are earning, in the neighborhood of 4 to 5% on taxable accounts at this period of time from an income yield on interest-bearing accounts. We've talked about methods. Postponement of debt forgiveness is one that we don't talk about very much, and hopefully we don't run into this, but if we have debt forgiveness, it is considered income, so that could be an issue that could drive up our income base, and could we move it into a future tax year? And defer sales on capital assets. I would just be careful in this strategy as you're working with your investment advisor. I'm a firm believer in diversification. I'm a firm believer in the investment advisors doing the great work that they do, and really to drive the portfolio. They need to be tax sensitive. They need to be tax efficient as much as possible, but let the investment advisors, rebalance the portfolio on a required basis on what makes sense from an investment strategy. Pay attention to taxes. If we can defer, that's beneficial, but just be careful that we don't let taxes weigh all our investment decisions. Couple of provisions that have been in play for a long period of time is the net investment income tax, this 3.8% surtax on unearned income. So we think about interest, dividends, capital gains, rents, royalties, non-qualified annuities. I think about this as the Obama surtax. So this has been in play for a long period of time. The thresholds are pretty low: 200,000 for married, 250 for married, 200 for single taxpayers. No significant change in these strategies, but they do apply when your income's over those thresholds. On your portfolio income, we have an additional 3.8% surtax. Also applies to those that are invested in operating companies that are passive investors and not active in the trade or business. The 3.8% surtax does apply, so it's still in play. Doesn't look like this would be, it's not scheduled to sunset with TCJA, so it's here for a little bit of time. The next provision is the 0.9% additional tax on wages and self-employment income, the Medicare surtax of 0.9. So in addition to the 1.45 paid by 45% paid into Medicare by an employee, 1.45 by the employer, so 2.9%. There's an additional 0.9% surtax for income thresholds, 200 for single, 250 for married, filing joint, that applies to the wage base. And this is still a provision that's out there. Larry, we got a couple of slides just on some deductions and credits. You want to run through these quickly?
Yeah, I can go through that. Yeah, so the standard deduction, this has been juiced so past few years. So, much larger than we had in the past. So 29,200 for joint filers. Itemized deductions, a lot of these, it's been 7.5% of AGI. The SALT cap we talked about was $10,000. So that is there. So, possibly if that does get repealed, we'll have a much larger itemized deductions going forward. Charitable contributions, these are, so basically you get the greater of the two, whether it's a standard deduction or itemized deductions. So, it makes sense in some years if you have some large medical expenses and you're going to go up through this, past the standard deduction, that would be a year to take advantage of that with maybe possibly charity. You're always trying to group these deductions and get them to spike up through the standard deduction level to give you some benefit instead of just, because the standard deduction is a free deduction. So you certainly don't want to be, giving charity and, hanging around the standard. You'd rather spike it to at least get a benefit for it. So you need to compare that every year and look at multiple years just to make sure you're taking efficient use of that.
Yeah, so if we take a quick snapshot of this page and we think about the standard deduction prior to TCJA, it was at 14,700, probably indexes up to about 16,000. So sunset happens, we go down to a lower standard deduction. State and local income taxes, it would be favorable if TCJA expired for that provision in and of itself because there was no cap of state and local income taxes and real property taxes. So that would go to an unlimited cap, but most likely would catch people subject to the alternative minimum tax. Charitable contributions, favorable provision in TCJA that gave us cash contributions to qualified charities at 60% AGI level. That goes back to 50% prior to TCJA. Mortgage interest, TCJA limited deductibility on new mortgages, limited to $750,000 of borrowing. If TCJA expires, it goes back to $1 million of borrowing, and then also up to $100,000 for home equity loans that are out there if used for improvements to the residence. So some favorable, non-favorable provisions that could be impacted by TCJA, but it'll be really interested to see what happens in 2025. A couple more.
Yeah, we talked about
the side.
Yep.
Go ahead, Larry.
Go ahead.
So a couple more on the medical side.
I'll let you go, Mark.
So a couple things on the medical side, obviously, subject to a 7.5% adjusted gross income threshold, meaning that all the expenses that get us to 7.5% of adjusted gross income are non-deductible. It's only those amounts that cross that threshold would be deductible in the given year, assuming that you are taking advantage of the itemized deduction. If you're taking the standard deduction, you would not get benefit of your medical expenses. And we talk about what the eligible expenses are, but really thinking about bunching strategies if possible, but probably more likely is consider using a flexible spending account or your health savings account to offset some of these medical expenses in a given year. A lot of folks have health savings accounts in today's environment, and you have the ability to accumulate money. You're not forced to make distributions from your health savings account. It's not a use it or lose it benefit. So that's a nice strategy to do some additional savings to save for potential medical expenses in the future. A little bit of information on charitable deductions. I talked about the 60% cash deductions of adjusted gross income for qualified charities, 501c3s, non-cash contributions, fair market value. I've seen a lot of case law out there today that talks about the lack of substantiation, lack of qualified appraisals to support the non-cash charitable contributions. If it's qualified, if it's publicly traded marketable securities, we don't need to worry about the appraisals. We obviously, those are locked in with readily attainable values that we can take the deductions, but it's more either private companies or hard to value items that we would need to get an appraisal and be able to document what the fair value is. We talked about the qualified charitable distributions. This was made a permanent provision. Again, age 70 and a half, although RMDs go to 73, this provision still applies to age 70 and a half. One of the strategies we've talked a long time about is donation of appreciated securities to avoid capital gains. If we donate appreciated marketable securities and that have been held for longer than a year, so they would qualify as long-term capital gains property, we'd be able to take a fair market value deduction for the charitable contribution of that stock, and you wouldn't have to recognize the difference between basis and fair value as gain. You get the full fair market value deduction as a charitable deduction. And so that's a strategy that's been out there for a long time. So if you're sitting on some appreciated marketable securities, consider using those as opposed to selling the stock and going to cash and taking advantage of that. Appreciated securities donated to charity have a 30% adjusted gross income level, so a lower level threshold that's deductible, but it's something to consider because you don't recognize the capital gains. And then we've talked about this before. If you're toggling between itemized deductions and the standard deduction, think about the bunching strategies of taking loading up on charitable contributions in 1 year to make sure that you can take advantage of the standard or the itemized deduction, and then maybe the next year you don't make any charitable contributions. You levered that in 1 year, and then you take the standard deduction in the next. And probably one of the best strategies to do this is with a donor advised fund. And I believe we will cover this in a little bit more detail shortly. Larry, do you want to talk about these couple of credits that are out there?
Sure. Yeah. So we talked a little bit earlier about, having, a dependent, classification as a dependent. And so some of these are, that's sort of a gateway to get into these kind of credits. So, and deductions. So yeah, the American Opportunity Tax Credit is really just available for the first 4 years of post-secondary education. It's up to $2,500 per eligible student. The lifetime learning credit is sort of as it says on the face. It's for, after the first 4 years, if we want to continue to learn and grow, there is a credit of up to $2,000 per return. Again, no limit on the number of years there. Student loan interest deduction, if it hasn't been forgiven, which I know there's some that did get forgiven, but if it hasn't, there's up to $2,500 per return. Although that does get phased out for higher income taxpayers, so not available to high income folks. And 529 plans, we talked a little bit about this earlier. Again, it's tax-free growth for qualified education expenses. You have the one-time $35,000. I believe you can do it $7,000 a year for 5 years. Is sort of how that works out. But you do get, there are some opportunities to front load those with gifting, where you can give 5 years of your annual exclusion, which this year is $18,000 and next year is $19,000. So if you wanted to front load those with five years of funding up front, you can do that. See a lot of grandparents to do that for their grandchildren. And then, obviously they can't make additional gifts to those grandchildren during that 5-year period because they've already used it, but it does allow for kind of a big drop in early and get the market working for you, for them and their expenses down the road. So,
you certainly have the ability to do the 5-year spread on a front-ended 529 plan gift, but you got to make sure that you file the gift tax return to make that election to do the 5-year spread. So significant money up front into a 529 plan. If we do the 5-year spread by using 5 years worth of annual exclusions, we have to paper a gift tax return to make that election.
All right. So we have our second polling question here that you can see on your screen. Are you comfortable with tax management strategies such as Roth versus 401k deferrals, Roth conversions, or charitable distributions from your IRA? A, yes, I have solid strategies in place. B, I could do better. Or C, no, and I could use some support. Give you a couple moments there to answer that question. Okay, looks like most of you have answered that question, so we will go ahead and continue with Mark and Larry.
Perfect. So now we're going to change gears a little bit and talk about just some common provisions on retirement planning, investment strategies, and then estate and gift planning before we wrap up with some checklist key dates and conclusions. Obviously, retirement planning contribution limits. These are indexed for inflation and change every year as the releases come out. But I think the key takeaway here is to just take advantage, the ability to set funds aside either tax deferred or on a post-tax basis. We're looking for folks really to supplement their retirement picture by contributing during their working careers and loading up and maximizing as much as possible. I think it's important to do so. When we look at the advantages of using the tax deferred vehicles that are out there, the one that's gotten a lot of talk and conversations over the years is a Roth account. So whether that be a Roth IRA or a Roth 401k, some differences between the Roth 401k and the Roth IRA, but in general, these contributions are made with after-tax dollars. So we have we've already paid tax on that, but the growth becomes tax deferred like a traditional IRA would be. And if the account is seasoned for 5 years plus, then the growth on that account would be eligible for tax-free withdrawals at a later date. The advantage of a Roth IRA over a traditional IRA is that there's no required minimum distributions for the original owner. So I establish a Roth IRA, I fund it over a period of time. When I obtain age 73, I'm not required to take distributions out of that Roth IRA during my lifetime as you would for a traditional IRA. Apologize. We see a lot of people taking advantage of making Roth contributions if they're under the income thresholds in which they have the ability to do so. We also see the opportunity for a lot of folks that will make what we call backdoor Roth contributions. And that can play out nicely, assuming the taxpayer does not have other traditional IRA accounts. They make a non-deductible IRA contribution, and then they convert that non-deductible IRA into a Roth IRA. There's no income thresholds on doing a backdoor Roth. The threshold that you have to meet is that you have to have earned income, or your spouse has to have earned income in which to make a retirement contribution into an IRA. But if you're contemplating the ability to get money into a Roth IRA and try to do it in a tax favorable environment, you should discuss with your tax advisor on what a backdoor Roth would look like and whether or not you would qualify and what the impact of your other retirement accounts would have on your ability to do so in a tax efficient manner. One of the things that we've always, go ahead, Larry.
Yeah, I wanted to touch base on one thing or a couple things. One, we talked about the elective deferrals on a 401k account, and it was $7,500 for those over 50 is the additional makeup. And we talked earlier about that got increased for those that are turning 60 to 63 in 2025. So that goes up to 11,250. So for those of you that are getting ready to set your elective deferrals out of your 401k, you can go up to 11,250 instead of 7,500. So that's going to, some people want to hit the ground running in a market that's running up the way it is. They may want to hit some of that early, and so I want to make sure they get that. And this is, Roth conversions are important. These are big tax strategies when you're looking at what your income is going to be in retirement. A lot of people defer a lot of money in your retirement accounts. And when you have to start pulling them out, you really can't control, how much it's required. You got a minimum. You could always take more, but these high RMDs. What I would encourage people to do is look at where you're at now, depending, if you're pre-retirement or just newly retired, and you've got, maybe, 10 years, 8 years before you have to start taking your RMDs. It's a great time to take a look at your bracket then and compare it to the bracket now. And maybe we assume that the tax brackets are going to get extended. But you may find yourself in a higher bracket with those RMDs because if you've got a significant balance. So you may want to do some conversions during the interim period between now and retirement until you have to take the RMD, take advantage of a little bit lower tax bracket. Thanks.
Yeah, so a couple of watch outs. If you're going to be in a higher tax bracket in retirement than you are today, you probably would not do a Roth conversion unless there's a strong argument otherwise. If you're going to direct your IRA to charity, either when you get to 70 and a half and start to do the qualified charitable distributions, or you're going to leave it as a legacy gift upon death, you wouldn't want to convert money to a Roth IRA and pay tax on that. You would leave it in a traditional IRA and take advantage of the QCD during lifetime gifts and legacy gifts upon death. We've talked a little bit about the required minimum distributions. Significant change here is we've moved them out to age 73 starting in 2024 for those that turn 73 in 2024. Penalties associated with required minimum distributions if you don't meet them. The qualified charitable distribution will satisfy your required minimum distribution up to $105,000 a year. So you can use that to avoid dragging that required minimum distribution into income. On this slide, we have a couple of provisions on long-term capital gains, pretty favorable environment. We would like to believe that these will continue to push out through the President-elect Trump's administration. Top rate on long-term capital gains property held for greater than a year is 20% over an income threshold amount. We'd like to believe that's going to stay in play. Qualified dividends that was enacted many, many years ago still has a top rate of 20%, matching the long-term capital gains rate, assuming you're at the top, you've covered the threshold amounts. We talk about loss harvesting, and we talk about loss harvesting every year. It's a strategy that should be implemented every single year and throughout the year. There's a lot of sophisticated investment advisors will have investments in which they do loss harvesting throughout the year. So it's not just an end of year exercise, but if you're sitting on some embedded capital losses and you're comfortable with the position, you have the ability to trigger that loss and realize the loss in the current year. You have to sit on the sideline for 30 days after the sale before you can purchase that security back. So you need to watch out for the wash sale rules, but the ability to take a loss and offset some capital gains is out there. I would argue it's more a year-round strategy than a year-end strategy. But if you're sitting on an embedded loss, you might think about taking it today. If you're comfortable with the security, you have to be on the sideline for 30 days. The investment strategies, dividend income. We talked about qualified dividends in a preferential capital gains rate, top rate of 20%. most likely, if you're over a threshold amount, will be subject to the 3.8% net investment income tax. Non-qualified dividends are taxed at ordinary income tax rates, which could be as high as 37%, plus the 3.8% Medicare surtax. In this environment, you might want to look to where you house certain assets and whether you have them in your tax deferred accounts or whether you have them in the taxable account. And the flavor of the income matters, because if you think about distributions from your retirement accounts, your tax deferred accounts, all of that income, traditionally speaking, comes out as ordinary income, subject to the ordinary income tax rates. Capital gains and qualified dividends do not come into play when you're taking distributions from your retirement account. Specifically, it comes out as ordinary income. Larry, do you want to hit the estate and gift real quick?
Sure. Yeah, so gift tax exclusion, as you know, we all have the ability to give $18,000 per person for 2024, and that's going up to $19,000 in 2025. So if you're married, that's obviously $36,000 per person. So, this is one of those things for people that are at a high net worth, where they may have a taxable estate. These are good techniques to use to kind of keep some of the growth from pushing up into that 40% gift tax when you have a taxable estate. So always good to be doing that. There are unlimited exclusions. You have to thread the needle on those, though. Tuition has to be paid directly to the educational institutions. They can't be paid to, the parent of the grandchildren or whatever. It has to go directly to the institution. And the same thing with medical expenses that get paid directly to healthcare providers. So unlimited on that, which can be helpful in some cases. Strategies, use the exclusion before year end, because once it goes to January 1, the prior year is done. You can't do that. Gifts of appreciated assets is a strategy where you're transferring basis carries over to whoever you make the gift. So if you have a 10,000 basis and it's worth 50, you're basically pushing that gain onto them at some point whenever they sell the asset. But if they are in a lower tax bracket, it may make a lot of sense to do that. And then we talked earlier about a 5-year front-loaded 529 plan for education gifting. And Mark's right. You got to paper that. You have to make the election on the 709 to get that.
Yeah. So just real quick, to consider gifts of appreciated security, we still have a carryover and basis regime on lifetime gifts. The thing that we're two watch outs here. Helpful if you take the gift to someone in a lower income tax bracket, but we got to watch out for those children that are still in those ripe ages of 17 to under 17 or under 24. We got to watch out for the kiddie tax provisions, because we could get whipsawed and have the tax be paid up at the parent's rate. So just consider that. The annual exclusion has been released for 2025. That increased up to $19,000. The lifetime exemption has been increased to $13,610,000 for 2024. That is scheduled to go to $13,990,000 for 2025. The concern with the election that was in play is that right now under TCJA, this exemption gets cut back to the exemption amount that it was in 2010, which was $5 million indexed for inflation. So that might fall out to be $7 to $7.5 million. We think under President President-elect Trump's proposals that he would like to extend these favorable exemption amounts, but we shall see what happens with legislation in 2025. Portability was made permanent, so we're not worried about equalizing spouses' estates to make sure that they're using their full exemption. If a spouse dies with unused lifetime exemption, it can port over to their surviving spouse and can be used by their surviving spouse to make gifts during their lifetime.
Yeah, Mark, I think that the portability had broad-based appeal from both sides of the aisle, where you had, people that had simple estates that, like sweetheart wills, I get yours and you get mine. And without having an AB trust structure set up, that they would lose that portability and could end up wasting the exemption. So this portability, the price to pay for it is, even if you don't have a taxable estate, you do have to file the Form 706 and fill out all the assets and expenses. And it's a little bit less onerous than a full estate return, but it does have some complexity to it. And you get a little bit of a different deadline on that. So normal 706s where you have a taxable estate have 9 months. You have 9 months from the date of death to file those. With portability, you get 5 years from the date of death. So you do get a little bit of a rear view mirror on that if you want to file and port that exemption. So, if the surviving spouse receives all the assets from the deceased spouse, you could file the 706 and port to that $13,610,000 over to the surviving spouse to add to their exemption. And even if their exemption gets chopped with TCJA, if it gets chopped down to 7 million, with portability, now they've got the 13 million plus the 7, you're over 20. So it is beneficial to do that in a lot of cases if your estate is going to be over that $7 million. Now, so we've been encouraging clients to do some gift planning and move some assets out of their estate this year, and then especially next year. We'll start to watch just to see. Hopefully, I think Mark said this with his crystal ball, there was going to be a third quarter 2025 bill. So hopefully we'll have some clarity around that. But that would let I think if this doesn't get extended, there'll be a lot of planning goes on at the end of 2025.
Yeah, Larry, the one thing I would say is, although the election might have caught some people by surprise on the end results, and some people thinking that we were really going to have a push for the sunset provisions of TCJA, I would argue those that have been actively involved in estate planning, it's not a time to take a pause. I would continue to do the transfers that you've been contemplating. The nice benefit of doing transfers during your lifetime is you're pushing the future appreciation out into the next generation and out of your potential taxable estate. So there's a lot of benefit. The one thing that you do have is a little bit of time to make sure that the planning, that you're comfortable with the planning, that you have sufficient assets to do the planning. But I would not put full brakes on any estate planning. I think it's still a green light to take advantage of this, especially if you're at the wealth ranges where you're in excess of the exemption amounts.
Well, yeah, and with the SLATs, which the Spousal Lifetime Access Trust, which have really caught on lately, with the spouse's ability to pull money back in the event they gave too much away, it sort of has alleviated some of the spouse's anxiety about doing this kind of advanced planning when they're not really sure what's going to happen with the exemption.
All right, Brendan.
Yep. Okay. Polling question number 3. How do you currently manage your taxes? I handle them myself. I work with a tax professional or accountant, or a mix of both. Every year is different. And while you're answering that question, I do want to give just a quick plug for another webinar that we have coming up in January. It'll be held on January 15th. Our colleagues in Clark Schaefer Consulting and Clark Schaefer Strategic HR will be presenting on a number of topics that are going to include things like cybersecurity, human resources strategies, operational efficiency, among others. So if you'd like to register for that, you can click on that same gray box on your screen and register there. So it looks like most of you have answered this polling question, so we will continue on.
Yeah, perfect. So the last couple of slides before, we left a lot of material at the end for you to peruse and talk with your advisory team with. But I think this is a nice little checklist as a takeaway, 10 items to think about. We've covered some of these at a relatively fast pace, but these are things that you should talk to your tax and financial advisor with, just to make sure you can check these boxes, that you've considered these items all the way throughout the year. But now as we get to a close on tax year 2024, a lot of the tax planning that we do in the current year, our opportunities, our flexibility really decreases once we cross into the new year. So take a look at this list, consider sharing this with your advisory team, and make sure that you can check the boxes and that you feel comfortable as you enter into calendar year 2024 or 25. A couple of items that we have here, we're just throwing out some important dates and deadlines that are coming up as we think about the compliance season for the tax year 2024 tax returns, and then tax payments for tax year 2025. Obviously, the last day for most tax savings move is December 31st of 24, deadlines for required minimum distributions. The fourth quarter estimated tax payments, if you're making estimated tax payments, have to be made by January 15th, 2025 in order to reduce your exposure to underpayment penalties. It was only a couple of years ago when we reflect back on what the underpayment interest rate was. In the first quarter of 2022, the underpayment interest rate was 3%. It is now at 8%. So very important that you consider your exposure to underpayment penalties. And if you need to close the gap here for tax year 2024, January 15th. Deadline is April 15th of 2025, unless you extend your return, which you can get an extension of time out until October 15th of 2025. It's an extension of time to file, not an extension of time to pay your tax liability. So you need to have your taxes paid in by April 15th. And then we have the cadence for the other quarterly estimates as you think about tax year 2025.
Hey, Mark, one quick thing on estimates. You know, estimates you have to pay quarterly. Withholding you can do anytime during the year, and it's treated as evenly paid throughout the year. So if you have the flexibility with bonus or an IRA to take withholding out of those income streams, that is considered evenly paid throughout the year, even if you do it in December. So Mark talked about, you know, the AFR of 8%, these 8% underpayment interest rate gets pretty stiff. But if you have the flexibility to take things from withholding sources later in the year, then you've kept your money in your pocket, earning, you know, the investment rate of return on that, and paying that in as late as possible, but also avoiding the underpayment rate.
Perfect. The last prepared slide we have is just talking about really as we think about seeking professional advice. The tax laws are complex. They're constantly changing. And this year, as we go into a new regime in Washington in early 2025, keep attention to what's going on. Work with your advisory team to make sure that you're aware of the changes and the impact it has with you. You can read a lot of great information out on the internet to make it fact specific. Engage your advisory team to get there and deal with personalized strategies, long-term planning, risk mitigation, and take the time and energy to focus on your family and pay for the advice to help with your financial affairs. And just a summary on the last slide. Work with your advisory team, gather your financial documents, try to have an idea of what your tax picture looks like before you close the year. Any year-end moves that you should make, you still have 21 days, which is a lot. It's going to preclude you on some charitable giving from a donor advised fund. Community foundations will have a cutoff date. Make sure you can try to squeeze in underneath of those if possible. Just make sure you know the landscape. To try to do the year-end planning on the last 2 days of the year does not lead to great success for many people.